Wow, what a week it was last week. We saw lots of intraday volatility. At the beginning of the week, we saw Trump start the tariffs, but then pause them for Mexico and Canada. Mexico in the morning and at the end of the day for Canada. So we saw a lot of market movement on currency sectors of the market. And after that, overall, the market did okay. The U.S. market was down slightly for the week, and same with the Canadian stock market as well. Now, the expectation was that, the tariffs are just look, they're going to be paused forever and all that. Trump is just using this as a bargaining tool, and there won't be any tariffs down the road. Well, Sunday night when I'm filming this, he's coming out with reciprocating tariffs on countries, including Canada and Mexico as well, and putting tariffs on steel production. So it's going to be really interesting to see what happens. This is by no means over. In fact, I truly believe that there'll be tariffs. They're not 25% down the road, but they'll be matching and there'll be more tariffs. And right now, the EU is definitely taking advantage of the United States. For instance, they have 10% tariffs on all North American cars versus the U.S. only has a 2.5% tariff on European cars. That doesn't make any sense. The playing field has to be equalized, but there's going to be a lot of volatility that's going on back and forth, and the car market's going to be one that's going to be battered. Canada put on tariffs on China, 100% tariffs, after the U.S. did exactly the same thing as well. It's back a few months ago, and they really didn't give a reason for that. They didn't say it was for dumping because they were selling below cost in our countries. They just did it. So there's a lot of stuff going on. And the markets have to work their way through it. I think we're going to see this tariff battle going back and forth, not just with the U.S., but other countries as well. So let's take a look and see what happened with the markets last week. Okay, if we take a look at the U.S., S&P 500 is down 0.2%. The Canadian stock market was down 0.4%. Not much of a difference. Interesting that China up 4.7%. The emerging markets also up 1.4%. So we're seeing a little bit of strength in emerging markets, China. That's a little bit to do with what's happening in the commodities. We're starting to see some of the commodities increase here. And I think that's a little bit of a rotation away from some of the growth sectors in the U.S., and we'll talk about that today. This graph shows in white, this is the S&P 500 last week on a day-by-day basis, and this is the TSX Composite in Canada. You can see here that the Canadian market was down quite a bit on Monday, and the other day I wanted to point out was Wednesday. Look at this. The Canadian stock market strongly outperformed the U.S. stock market, and I want to talk about that in the context of what sectors are driving this. First of all, if we look at the S&P 500 GIC sectors, the consumer discretionary sector was down 2.8% last week. The other sectors, really, there's not a lot going on here. Yes, there were some differences, of course, but the big story was consumer discretionary. Amazon came out with its earnings and gave weaker guidance on a go-forward basis and has been stumbling recently, as has Tesla. And those two stocks on a cap-weighted basis make up approximately 40% of the sector. So as they've had some trouble, we've seen this sector have trouble. And as well, we've seen a little bit of stumbling with the retail sector, which is a subsector, but we have seen that taking place. If we look at the commodities, some commodities and also the equities with them as well, natural gas, it's been a cold winter. Also, the tariffs, proposed tariffs helped prop up that sector. And gold miners up almost 5% last week. Gold miners have been on fire recently. We're going to talk about that. Gold last week was up 2.2%. And part of that's been a little bit of gold getting in the news. In fact, I was on BNM Bloomberg, the street, 8 a.m. on Tuesday last week, talking about how because of the proposed tariffs that may take place on the UK, we've seen investors or large companies move their gold from the LMBA in London and moving over to the United States to the COMEX. And the inventory has just been skyrocketing recently. And traders have been doing that to avoid any potential tariffs that could take place here. So that news, that uncertainty around gold has helped to propel gold price higher at this time. As a result, gold miners have done quite well. Silver also did quite well last week. This graph shows gold, silver, and gold miners here on a day-by-day basis last week. Look at Wednesday. And so that's one of the reasons why the Canadian stock market outperformed on Wednesday. When you find the gold miners really strongly outperform, it's not just gold miners. Usually it's a lot of the other stocks in that area, which helps to propel the TSX higher, especially if tech is stumbling on that day. So we did see that strong gain for gold miners as well. This is the same graph I showed you earlier with the S&P 500 and the TSX composite day-by-day basis. But this third column, the gray one here, is the metals and mining sector. We're starting to see a little bit of strength in this sector. And look at the action on Tuesday in that sector. It really performed quite well. Technically, I'll show you in a second or a minute that we're starting to see some strength for this sector. If we look at this graph, this goes back to January 2024. We've got S&P 500 in the white, the metals and mining sector right down here, which is in the orange, spot silver in the yellow, and then gold in the red. And green is this bright green is the GDX gold miners here. The one thing I wanted to point out here is the starting seasonal period for gold miners, gold and silver, is all at the end, the last couple of days of December. And sorry, my line's not very good there, but you can see gold miners, silver, and gold all doing well right at the beginning of their seasonal period. Now, it doesn't always work out that way. And we're seeing continued strength with these sectors. A lot of it has to do with uncertainty in the market and the rotation away from some of the growth sectors. Well, last week we saw that away from the consumer discretionary sector. And investors are moving and they're looking for other places. And the precious metals is getting a little bit of attention here. This graph shows the technology sector relative to the S&P 500 here, and this yellow panel here. I wanted to draw this line all the way out here, this box here, and show you the technology sector relative to the S&P 500. Now, a lot of investors don't like me talking about the technology sector because, unless I say really positive things about it, they get upset. Now, I think the technology sector is great, but there's times where there's other parts of the market that are more interesting, especially if investors are fading the market. Here we are well into the Q1 earnings season and Q4 earnings season, and investors are, we've seen the earnings come out for the major technology companies. And a lot of them haven't really pushed the market higher here. And we really haven't seen that really burst from the technology sector. And there's not a lot to move them forward. Of course, another DeepSeek or something like that else could have an impact as well. But there's not a lot of impetus for these technology sector outperform. We are at the lower end here. And if we take a look here on an absolute basis, let me draw this here with a line instead. You can see here we've actually broken this upward trend and we're moving sideways for the technology sector. At the same time, the RSI is moving lower. This is a divergence. It doesn't mean the sector is about to crash. It just means that it's a weak signal showing that the sector could lag the market here at this point. It's just something to watch out for. And if the technology sector continues to move sideways or heads down relative to the market, then that would actually indicate that investors could be looking at other parts of the market. And that's what we're trying to show you here. This graph shows XME, and this shows XME, the metals and mining sector relative to the S&P 500. We did see that big drop down for the sector in December, and the same underperformed the S&P 500. It's starting to outperform here a little bit and moving higher. We saw that bounce higher off an oversold position. We could see some strength in this sector, but it really depends on these the tariffs, the reciprocal tariffs, if there's going to be a delay on these and negotiations going back and forth, and where the companies are actually located geographically as well. And if there's going to be counter tariffs in this sector as well. If everybody's putting tariffs on the metals and mining sector, we could see it actually slow up here a little bit. On a technical basis, it's looking good. But the Trump tariffs and counter tariffs could actually throw that off. If we take a look here at the S&P 500 on a monthly basis from 1950 to 2024, February is actually one of the weaker months of the year. We're still in that strong seasonal 6-month period for the stock market, but this is that odd month that tends to be weak. On average in this time period, it's been flat, and on the median basis, it's just been slightly up as well. And it's only been up 55% of the time. So it can be positive, but this is a time when we can see the market actually pull back. It's one of the weaker months of the year. We just have to be cautious at this time. Here's the S&P 500. If we take a look here, this line going up, there's our uptrend here, really an up wedge here. We've broken out sideways. And if we take a look here, we've also got the RSI, very similar to technology. It's been heading down. So this has been a bit of a divergence here, which doesn't mean the market's about to correct, but it means that it is starting to show some weakness here. We have to watch out for that. Right now, I think the conditions are still good for the stock market, but over the next few weeks in February, given that it tends to be a weaker month on a seasonal basis, we're starting to see some weakness on a technical basis. We could see the market pull back here a little bit and soften up over the next couple of weeks. It doesn't mean it's going to for sure, and the prognosis for the stock market for the next couple of months is still pretty good at this time, but in the shorter term, given everything at this point, there's probably not a lot of upside opportunity here, and we could see the market even pull back a bit, which is totally possible. We'll have to wait and see. Thank you very much for joining me today.